There's a lot to unpack, I think, in the precious metals space. And I mean, I've been talking about precious metals over the past week and a half, really saying like, hey, it's starting to go parabolic. The signs are here. And the big question is, as you just mentioned, David, you're like, out of nowhere, the top was put in, or we had this big reversal. And that's the problem when things get a little overheated. We start to go parabolic. And again, the monthly chart of gold, silver, miners. I mean, if you zoom back in time and you go look at, the previous ways that gold has moved, usually this doesn't end well, right? It's just a typical scenario. You could give this to a fifth grader and be like, what happens? What should happen next after this, right? So that's like the super basic high level. But when we zoom in, you and I spoke a few weeks ago. We showed the intraday charts, and silver was poking up and trying to break to some new all-time highs. And we were seeing in gold and silver some big intraday bouts of selling. So somebody was unloading contracts, slowly getting out. And the market, to me, in the precious metal space, I've been sharing this quite a bit, saying, it's a crowded trade. I've mentioned this many times over the past year of you and I speaking together, that eventually, when I think we have like an economic reset and when gold finally does peak, it's probably going to pull back 30, 34, 35%, somewhere in there. And that's kind of, if we go back and look at the 2011 peak, the market pulled back about 45%. In 2008, during that financial crisis, it pulled back about 34% or so. I do believe eventually, using just Fibonacci retracement, based on the size of this run, there is potential for gold to pull back to the sweet spot. And the sweet spot is between the 38% pullback all the way to a 61. And so we could see this pull back 27% all the way down to 45%. That is typical. That is how the universe works based on Fibonacci theory. And also historically, we've seen prices in gold. So when this does come to an end, wherever the top is, we still need to wait for the top to be kind of nailed down for gold. It could be much higher still. Then we can calculate, okay, where should it settle out? And obviously you don't want to be holding it as it goes down into these levels. There's going to be a time where you might want to actually like lock in profits, lock in gains on gold, because it could go dormant for 6, 8, 12 months and lose 20 to 40%, or it could go dormant for a decade, right? And that's the most expensive thing us as investors or humans have, is time. So who cares if you don't own your favorite asset for a little bit? If it's putting in a top, just buy it back later at a cheaper price, or potentially even pay a bit higher price later, but after it's stabilized and is ready for another leg higher. So
when we examine past peaks, such as 2011 or the 2008 crisis, a climb of many years was followed by a dramatic decline of 30 to 45%. A similar corrective window now appears plausible for gold. After a steep ascent, the market may test support similarly deep. In this light, gold doesn't simply continue upward unimpeded, it pauses, unloads frothy positions, and consolidates. For those holding bullion, miners, or contract exposure, the strategic decision becomes whether to ride the entire legion of the move or lock gains and await a lower re-entry point.
That's the way I look at gold, and I believe we could go into a very big correction. Now, you mentioned, David, is it going to be like 2011? I mean, that was a really long dead period. I think it's going to be more like 2007, 2008, where it's going to be just a sharp, violent pullback, and then it's going to recover, because I think there's a lot going on right now that's going to spur gold for another big leg higher. So I don't think it's going to be like the 2011 in terms of time. It didn't take 10 years to come back. I think it's going to rebound with a vengeance in a shorter period of time. If we take a look at the charts, there's a lot to unpack, I think, in the precious metals space. And I mean, I've been talking about precious metals over the past week and a half, really saying like, hey, it's starting to go parabolic. The signs are here. And the big question is, as you just mentioned, David, you're like, out of nowhere, the top was put in, or we had this big reversal. And that's the problem when things get a little overheated. We start to go parabolic. And again, the monthly chart of gold, silver, miners. I mean, if you zoom back in time and you go look at, the previous ways that gold has moved, usually this doesn't end well, right? It's just a typical scenario. You could give this to a fifth grader and be like, what happens? What should happen next after this, right? So that's like the super basic high level. But when we zoom in, you and I spoke a few weeks ago. We showed the intraday charts, and silver was poking up and trying to break to some new all-time highs. And we were seeing in gold and silver some big intraday bouts of selling. So somebody was unloading contracts, slowly getting out. And the market to me in the precious metal space, I've been sharing this quite a bit, saying, it's a crowded trade.
Sentiment matters. The recent surge in gold and its miners has drawn in a wave of new participants, not just core holders, but incremental buyers fearful of missing out. The volume, the volatility, and the sharp intraday reversals signal a packed trade entering the danger zone. When an asset becomes everyone's favorite, it loses the edge. That doesn't mean gold must crash from here, but rather that it might be vulnerable to a sharp technician-triggered reversal. The kind that happens when momentum traders hit the door together.
And a lot of people are saying, well, Chris, it's not crowded. The retail traders are barely even in. When I say a crowded trade, which I believe gold is based on many different things, just the price action is signature of a herd mentality. The volume is a signature of everybody's piling in, chasing pricing. But when I say it's a crowded trade, David, I mean, not the whole world's piling in, just the people who are open-minded, who are willing to potentially buy gold, silver, or miners, or the other metals, are all piling into it. And so it's most people don't hold gold. There's a very small group of people that actually hold gold in their portfolio, but the people open-minded enough to do it are all piling in, and now they feel like they're missing it. And we saw this like over the past week. You could cut the air with a knife, the FOMO that was in this space for people who aren't in it. And so there's some pretty interesting charts when we look at the daily chart here. Gold is starting to have some big back and forth swings. I don't think this is the top yet. I actually think this is just one of the hiccups along the way of it potentially rocketing higher. And one of the best scenarios is if we go back to 2007, which is the chart on the left. We have the S&P 500 candlestick chart. The yellow line is gold. And on the right-hand chart is where we are today, right now, with the same two things. Now, you and I touched on this in our last talk, David. But what's really interesting of where we're at now is the stock market just had a bout of selling a week and a half ago. And so now it's showing a little bit of weakness.
Zooming in, we see the classic top-forming behavior. Weakening swings after strong runs, sharp intraday selling, miners lagging while metal prices extend. This echoes previous cycles where major tops were preceded by 3 surge peaks, followed by a breakdown. In the current cycle, the metals complex, gold, silver, platinum, palladium, shows a similar choreography. Gold leads, then miners and second-tier metals fly until sentiment changes fast. The intraday evidence of unloading contracts and aggressive profit-taking suggests we may be approaching one of those key structural inflection points.
Gold has had a big first pullback right here, which we can see on this yellow chart in the top right. If we go to 2007, it started to have a little bit of weakness, the stock market, and gold started to pull back. Now take a look at this. When I show you the other asset classes, so the chart underneath is GDX, gold miners. And then we have silver, and then we have platinum, and then we have palladium. Look what happens like just near this end where we see gold miners shoot higher. Everybody starts piling into silver, platinum, and palladium. It becomes a bit of a crowded play. And if we were to just kind of fast forward this, you'll notice gold at the top continues to rocket higher. It continues to move up. It moves up it doesn't look like much on this chart because it's condensed, but it still has another big push to the upside. Miners struggle to move higher, but we see silver, platinum, and palladium still go parabolic. They actually take off and pick up speed. Now, if we were to just kind of backtrack to kind of where we were in 2007 and look at where we are right now, notice we've got miners, we got silver, platinum, palladium, all coming to life. This is the first hiccup, the first quick knee-jerk reaction where people who are chasing pricing and buying, over the last week or so are emotional because they bought in emotionally. They have FOMO. So it doesn't take much of a pullback like today to really spook everyone out and create this first move. But I do believe we're going to see, I think the metal space continue to rocket higher. This is nothing but a bull market trying to buck people out of gold. And I think it's going to want to go higher here. But there's no doubt we're on like the last major push, I think, in metals. And then
a pullback doesn't automatically equal crisis. In fact, recent commentary argues this could be a healthy reset rather than the end of a bull run. After rapid advances, a correction and consolidation phase is entirely consistent with an ongoing secular uptrend. Analysts expect gold to pause, potentially unwind 20-40%, then gather strength for the next push. For investors, this means resisting the urge to panic sell now and watching for where support forms. The low-risk re-entry zone may lie after the correction finishes, not at the top.
The question is it like 2011, like what you mentioned, do we go dormant for another 10 years after that? And does it cut its pricing? Like, do most things fall 30 to 50 or 60%? I don't know. That's why I just follow price. When things top, I get out. And you don't have to really worry about how long it's underwater because we don't hold it. But this scenario of where we are is like the perfect storm brewing of the crowded play. Everyone's moving into all the precious metals, silver and miners as well. And that tells us that it's, a little frothy and it's going to be a wild ride going forward. After we see like a 30% or so pullback, I think it's going to rebound and stabilize. And I think it's going to go something like this. Like, I think we're going to see another big leg to the upside. So like, for example, if we were to use Fibonacci extension right now, we can say, okay, based on this low, based on the high, this is just the current high of gold. It may be higher later. But if we come down and settle into this 50% retracement, this tells us where the next upside target for gold is. And this is going to be really exciting because, when gold comes down into this area, it's going to rally up to 4,800 and then about to 6,500. So there's quite a bit of potential still to the upside. I don't think it's going to quite get to this level on this run. I think we're going to stall out probably 48, maybe 5,000, maybe. I'm not sure. But we'll be able to calculate where gold should run. But right now, gold has blown past all of its Fibonacci targets to the upside. So it is in no man's land. It's just bubble phase. And this is, you nailed it right at the beginning. Like, how do we know when it's going to, it just came out of nowhere. Well, that's what happens in a bubble. It just bursts out of nowhere and you don't know when. And so that's why traders are on edge. That's why we're seeing heavy selling. Miners are down over 10%, 11% today. Silver and gold both down really big. It's because people are worried it's going to be the burst. But I think this might actually just be kind of the first pullback before we have another push higher going forward.
What should you do? First, define your role. Are you a long-term holder or a swing momentum player? If you own metal and the top hasn't yet confirmed, consider hedging or scaling out. If you're buying new, use the pullback to layer in at better levels. The macro backdrop remains supportive. Inflation, monetary and fiscal strain, currency risks, central bank diversifications, so gold's structural case remains intact. Yet, timing matters. We may be at the cusp of a key reset. Prepare for volatility, protect gains, and keep your focus on the next leg, not the top.
It really depends on the type of trader you are. You're saying momentum, and generally when you're talking about as a momentum trader, you're usually looking at, maybe a 30-minute chart, something that can carry a pattern over several days. There's no doubt the trend is down on an intraday chart going back the past few trading sessions. In the grand scheme of things, if you are a swing trader, technically it is still holding up. The moving averages are all still sloping up. Price is pulling back to the 20-day moving average, which is this pink line, which is a natural pullback level. I wouldn't be panicking out here at this point. I mean, I think most of the damage has just been wiped out. If you sell right here, you're probably going to be exiting at a point where it's about to bounce and want to go higher. But yes, there's no doubt people who have been piling into silver over the past month, they're right back down to kind of where they are, where they entered. And now it has a pretty scary looking chart pattern that if it does continue, it's going to be back down into the 30s in like 3 more days, right? So it carries a lot of fear. Definitely silver moves at the speed of light. I mean, it takes the elevator straight down. But it's a very small market, and that's why it moves really quickly. So if you are a momentum trader, the trend is down if you're looking at short-term charts. But if you're looking at still as a long-term investor, this is just a pullback within the big picture of a bull market in gold. And I think it could stabilize here, maybe even trade sideways for a couple of weeks. And then it maybe breaks and runs higher to the upside. So I wouldn't be panicking out as an investor just yet. I'm looking to sell my physical gold holdings, but I'm not trying to pick a top at this point. I still have to let a top form. And then when it looks like it's, potentially breaking down, then I will exit. But right now, if we look at silver, and we were to just kind of draw what typically happens after this kind of volatility where volume ramps up, it becomes a crowded trade. Usually you get a sharp pullback and then it muscles its way higher. And what'll happen is it can it can really have some of the biggest percentage moves right near the end of a trend. It could come up and have a couple more of these, and eventually there's this pattern I always look for that silver could make here is three surges to a high. And this pattern is a very, very violent topping pattern, meaning this would be one surge to a high, then it pulls back. We have another surge to another high, and then has a very sharp pullback, and then it does a third one. And usually after that, that's when things actually break, and then it goes into a much bigger, unwinding event. So that's one thing to look for in silver and gold and miners going forward. But right now, a big down day here to support is not something to like throw everything out the window and bail on it yet. I mean, I do think we're close to a top, but it's technically not in place yet.